Hey, what's up, everybody, and welcome to episode 21 of Real Estate Agent Rehab. It's Amir Al-Kayat here, and we have a special episode today, and we're going to be talking about the mortgage industry after the elections. And we have a special guest today with us, who is our VP of our mortgage division, Mr. Omeed. Please introduce yourself to everybody in the podcast world and real estate world for us.
Thank you, Vance and Amir, for having me. First off, my name is Omeed, VP of West Shores Financial. I'm really looking forward to talking about what's going on in the market right now and what we can see in the near future as far as interest rates go.
And as always, we have Mr. Vance
on deck. Good afternoon, everybody. Looking forward to this post-election conversations. What have we got in store for the next 4 years? So, Omeed, let's jump right into it.
Yeah.
What can we expect before January?
Before January. All right.
I mean, that's not much.
Not much time, but nevertheless, there's going to be, there's some data that's going to say, okay, where we're going to be. Now, that night of the elections, when it looked like likelihood that Trump was going to win, the 10-year Treasury yield, which the interest rates follow, jumped up real good to a point where it was about a 0.25% difference, from basically Wednesday night till the next day. So, and the reason why is that some of the banks, they may know what's already going on. Sometimes they have information prior, it seems like. Mm-hmm. Like when the Federal Reserve cut their rates, right? When they cut 0.5%, the market was supposed to, interest rates was to come down. But it seems like the investors already calculated for that and knew that. So the rates went up after that. And election happened. Now, the rates went up. Today, we've actually pulled back. If it went up 0.25% the prior day, came back an 1/8% today. Main reason is that with the new administration, there's going to be new spending. The government is going to go into new programs, a lot more spending, and that's going to obviously affect the main pressure for a main measure for whether rates go up or down is inflation. So if you spend a lot of money up front and there's different programs going on, that's what they're considering for. So it seems like the rates are going to be either stable or slightly an upward pressure until January. And at that point, Trump will come in with his new policies. He's got several of them, and all of them can have great impacts on the economy, but may not have great impacts on interest rates. So that is to be seen, in essence. Couple things that I already saw, like if you're looking online, you look at TikTok, I use that for informational news. There's a lot of good news on there too, but saw a clip where Trump is trying to temporarily reduce credit card interest rate and cap them for a period of time at 10% because people have record high debt right now, right? Mm-hmm. And because of record high debt, interest rates can easily get from 17% to 25% on a payment, right? So you can see how that's really hurting people. But if you put a cap on 10% right now, here's what happens. Like, ultimately, people are not good at saving, right? If they got extra money, they're going to spend it. So if you're saving money on your credit cards and you're going to take that money and you go buy a bunch of different things, right? Buying stuff, adding to the economy, that's not going to help with inflation, right? In essence, you're going to have more money, spend more, economy's going to do better, rates are not going to go down, right? So, and then as far as getting home equity lines of credit, refinancing, those opportunities may not be as fruitful during that time frame where people have a 10% interest rate on their credit cards. So, but in general, I guess his concept is Trump is trying to get the economy to be overall more healthy, where if these rates, and in a healthy economy, the rate should be around 6-7% in general. Right. The 2-3% that we had before was an artificially infused market. The government had a bond buying program, 10-year Treasury yields, and that's what artificially made the rates go down so low. That
started in the first year of Obama, which was quantitative easing.
Exactly. And that ended about 2 years ago in November, in March actually, and they pulled back because they were buying billions of dollars a month of Treasury yields, and that's what made the rates go down. But healthy economy should be around 6-7%. The general goal of the past year we had some lower interest rates down to about 5.99, right? Mm-hmm. Right now, the national average is around 7.13%, as far as the national average. And the goal was hopefully by end of 2024 to 2025, get to near 5%. Okay, what that 5% mark is very important because people that bought a house or refinanced, majority of mortgage holders, they're in like 2s, 3%, right? Mm-hmm. One of the issues with the supply, at least in California or Los Angeles, where in general, is that people feel handcuffed to their mortgage rates, mm-hmm. right? If you have $1 million house and you're paying 3%, are you going to go sell that house and go get a loan at, buy another $1 million house at 7%?
No.
Does that make sense? Mm-hmm. Right? So they feel handcuffed and they can't move because of the interest rates. Mm-hmm. Now, if we got closer to 5%, that's when it actually would make sense for a lot of people to be able to sell their homes, right? And for affordability reasons. So that 5% number is important to get to in order to have more transactions and more supply here.
So how do we get there?
The main thing is Federal Reserve, when they keep looking at data, is inflation, right? Inflation data.
Right, but I mean, I
How
get
do
it.
we get there?
I get that. But
Okay,
let's just get into this conversation.
Yeah.
I always have this. We want a strong economy, but if we have a strong economy, we have high inflation.
Right.
So if we have less jobs, then if we have more people working, then they actually want to reduce the workforce to put people out of work.
Right.
To worsen the economy, to lower the inflation. So explain this to me, because I'm a finance expert, and I still don't get it, okay?
Yep.
I'm 10 years off Wall Street, financial planner, and I look at these numbers and still look at it and say, this doesn't make sense, because if we're trying to get to 5 or 6%,
right.
the best way to do it would be to have people able to spend and pay that, which would be to have a strong economy,
right?
Which would be to lower the interest rates and get people to have the money in their pocket and get people working, as opposed to pushing people out in the street, stopping them from working,
right.
raising interest rates, and cooling the quote-unquote economy just to slow down interest rates. I mean, just to slow down inflation, where, quite honestly, I didn't hear anything about inflation for the past 10 years until about 3.5 years ago.
Right. Great question.
So go ahead, blame it all on Trump, and then bring it back because he got reelected. So let's figure this problem out.
I guess the American population asked for it, but okay. If we have a stronger economy, mm-hmm. right? If people are going to save, maybe actually create savings for themselves, right?
But they don't.
They don't.
So not if
all right,
they
so
don't.
Then stuff that if he's going to come in, for example, cut interest rates as far as credit card interest rates, cool, mm-hmm. right? Then that means at some point they're going to have to artificially infuse the market again. What's some kind of program from the government? If they're going to subsidize electricity costs and energy costs,
why would they do that?
In order to be able to, real estate's a big moneymaker too, right?
Yeah.
And so that would, in order to help, if one of the main issues is people need to get into homes, American dream, right? Okay. If he's really about that, mm-hmm. then maybe they're going to create programs or provide grants or artificially infuse the market like they did before and bringing the rates down. These are kind of things that you can do while having a strong economy in order to make everything more affordable. If people start getting paid more, right, then maybe if they get paid more, then obviously they're going to spend more, right?
Right.
So they're not going to make more, and then the rates are going to stay steady, and then they're going to basically be able to afford homes more, right? I've heard something else where they're like, okay, we're going to,
Well, here's the thing, too. If they start running out of money, they're going to stop spending. And so indirectly, I mean, either if we keep spending and putting it back into this inflation deal, that eventually they're going to run out, right? And then at that point, then maybe we'll see a shift. Who knows? But I think the government's going to be the one to kind of have to step in again.
They're going
to make some things happen if they want to make a change. But again, the market's still healthy indirectly at this range.
Why do they need to step in?
So if they don't step in, right, and
right now they're lowering interest rates. They're infusing more money into the market just by allowing people to have more money.
Right.
That's a bad thing.
For interest rates, right? It's not a bad thing for the economy, or maybe as far as people having
But okay, I'm sorry.
Yeah, it's
This always confuses me, and this is great. We actually we can have this conversation. 6-7 years ago, we had interest rates at 2.5-3%.
yeah,
No one was crowing about inflation,
right.
right? Everybody was making tons of money. We had home prices going through the roof. Everybody was living this great dream. What happened?
Okay.
Why all of a sudden are we now focusing on inflation, and has it become this major issue? And if we make any more money, it's only going to make the problem worse.
Great question. So in essence, before, when there was government programs, bond buying programs, you're right. People were making money, so, and prices are going up. They didn't have any concern with that. When the Federal Reserve, at some point, they're like, okay, we have to actually we can't just do things and have government programs to be able to help things out. They want to base it on something, and what they're basing it off of is inflation. That's the only time when the Federal Reserve the past few years start talking about inflation, right? They're like, we need to be based on economic data-driven actions. So before they weren't looking at economic data per se, right? They just it seems like these programs were there to stimulate the economy and create more jobs, give people more money. All those programs we did with COVID programs, Triple P, right? All those monies came in, people used those and utilized it, and the market grew. But now it seems like it grew a lot, and that's when inflationary pressures are coming up. And the Federal Reserve is like, okay, we can't just arbitrarily move up and down the rates. We got to peg it on something. So that seems to be more of the focus now, because that's all they keep saying is like, we got to look at the data, right? And if they look at the data, it's unlikely they're going to be able to reduce the Federal Reserve rates again by the end of the year, because we have very strong job reports come out right after the Federal Reserve announced their 0.5% interest rate cut, and that was the main thing. That's why it's still the rates are still going up, mostly because of economic factors. So if we don't have any data saying that inflation is getting better, they're going to basically either pause it. My opinion, they should have probably raised it much more earlier, sooner, and get that over with, have a harder period of time. And then it would have been like, okay, now we got there, we have a lower basis for interest rates, people can afford more homes. They get into it, then, these other programs.
So people could afford more homes if
the interest rates come down, right, like 1%, for example,
okay, yeah.
About 4 million more people in America can afford a home.
Right.
Okay. And then if it went down like to 5%, then we got about almost 11 million more people in America that can afford a home.
And we still have a 5 million home deficit.
Right. And
so even if everybody in America bought a home today, we'd still have 5 million less homes available.
Which is a huge problem.
That's a massive problem. And that started in 2007, and we haven't been able to capture that since.
And at least in California or Los Angeles, if they change some of these like short-term rental laws and licensing and getting registered and paying for them, that could open up some supply. That's like the only thing that they got. And Southern California that may change basically pricing for homes and bring them down and provide supply is if they do stuff like they've done in New York, where you have to go pay for to be registered to do Airbnb or something. And then I don't know, all these trends of these little homes, boxables and stuff like that coming out, creating little communities.
Can I ask you a question about interest rates?
Yeah, absolutely.
Because that was really kind of where we started with this whole thing. The Fed funds rate.
Yeah.
It's not tied to the interest rate of mortgages.
That's correct.
Okay. What calculates mortgage interest against the Fed funds rate? Now, the Fed funds rate is what we hear every time they're raising interest, they're lowering interest, and everyone's like, "Oh, great, interest rates are going to go down." They're not tied together.
No.
So how are they intrinsic and how are they working with one another?
Gotcha. Great question. Federal Reserve rates are short-term rates. They apply to credit cards, car payments, student loans, right? So there's short-term financing. And
overnight bank rates.
Overnight bank rates, exactly. Overnight bank rates, what they lend to each other. Mm-hmm. That's correct. So that's the Federal Reserve rate. So when the people heard, oh, Federal Reserve cut their rates 0.5%, that doesn't mean the mortgage rates cut 0.5%.
Right.
They're not. It's not causation. They're correlated in a way where, if whenever like investment products for investors, like if the rates change, they may allocate their money in different places. So even though when the Federal Reserve cuts their rates, then investors may change their perspective as far as where to invest their money, and that can affect the 10-year Treasury yield, which 10-year Treasury yield is what the mortgage rates follow, right? So that's in essence, the climate and the investor climate changes when the rates go down. And in this case, when we had the 0.5% lower interest rate, the market did the exact opposite for the rates, right? Mm-hmm. We thought that if it came in 0.5% better than the market expected, whenever you get news that's better than market expects, then you're getting it some reprieve as far as release as far as the rates goes. But this time, even though we got a large cut, it did not do this effect. It actually went up, right? It basically went up 1% in a matter of a month.
Why do you think that happened?
They know this data and they price it in prior.
So they saw it coming from.
They saw it coming and they started pricing it prior. Mm-hmm. When they knew that, when the lenders knew about a month and a half before, the market dictated that the Federal Reserve needs to cut their rates, right?
Right.
Before, and then everyone's like, you have to, right? It's going to be, if you don't, there may be lagging factors. We might get in a worse position. So
then, what is it? Before the summer, when we expected them to cut the rates, and everybody priced it in, and they didn't.
So
that really
when we heard that news that they're going to basically cut it, their rates came down. That's when it was down to like 5.99%. Right. And then when that news actually came out, since the fact they had that price in the whole month prior, when the final news came out, they were anticipated that too. They're okay. Now we're going to go up again. Right. So lenders and banks and everything, they're going to take their opportunity to make their money too. Right. So they have insight. They got a lot more data points that we have available to us, mm-hmm. and they position accordingly. So, the whole time I was saying, okay, yeah, it's already priced in this improvement. People, unfortunately, not knowing the relation between short-term Federal Reserve rates and long-term mortgage rates, like, okay, well, we're going to wait for the Federal Reserve to cut their rates again, right? We want the rates to go down even lower. Okay. They got greedy, right? And then what happened? And basically now 1% higher, about 1.15 or 1.25% higher, and all those people that could have bought at that time now can't qualify for the same amount of home, right? So that's the intense one, unfortunately.
Moving forward, where do you see interest rates going in January?
Eventually, I think they're going to ease. Until January, I believe there's going to be stable to a little bit higher, maybe 0.25% higher, mm-hmm. right? We're still far off from where a 10-year Treasury yield with the rates fall is around 4.4%. We're as high as 5% like last year, where we're selling like loans at 8.5%, right? Mm-hmm. So I don't think we're going to get that high. I think there's room for it to go a little bit higher. And then once, January and afterwards, we're going to see what economic policies they're going to put in place. And the market's going to react based on what they think the cost of that is, right? And what they think the effect of it is going to be on inflation. So this inflation thing is just like I don't know. Like, let's say if they cut energy costs, that's great because energy costs is one of the factors.
That's right.
Right, of inflation. That'll be great.
Well, when did we see inflation come up? Was when we shut down the Keystone Pipeline.
Yeah. See, yes.
When they shut down the energy and made energy more money, all of a sudden, inflation became a major factor in our economy.
Exactly.
Until then, we didn't hear boo about inflation for 15 years.
Absolutely correct. And if Trump's going to continue doing whatever he can as far as fracking, investigating all kind of and trying to utilize the resources that we do have for gas, natural gas, oil, whatever. Mm-hmm. So that efficiency could help with inflation, right?
Well, that's it. I mean, the cost of energy, it's the one thing that we don't see a factor on. Right. The fact that our lights are on, that, our power works, that's just a given.
Yeah.
And that's really, from the homeowner, from the business owner, that's probably one of your highest costs.
Absolutely, especially during the holidays or the summer months, and you're on ACs, heating, and all that stuff. Very
imagine running a trucking company.
Mm-hmm. Yeah.
Well, now you're paying for all your overhead, plus all your fuel and all your insurance and all these things. So that's where I think we're seeing a lot of this inflation build in from. Hopefully it goes away. Hopefully it starts to ease down and we can see a little bit better
Better climate.
But I think all in all,
Climate,
there's
yeah.
going to be positive things that are becoming next
yeah.
year. You know, we've got a real estate man as our president, so he's going to be very thoughtful in what, you know, how things
Worked
go
out
down in our
pretty well last
industry. So fingers crossed we can get back to a healthy point. But I want to talk about something else. I want to just switch gears a little bit because we can speculate on rates and the future of the mortgage industry. But I want to talk a little bit about programs real quick. We got about 8 minutes left.
Yeah.
And just to you're a mortgage broker. You deal with a ton of different banks.
Sure.
And so, in general, what would you say for a first-time home buyer, what would be the best program that you would put them in?
Great question. First-time home buyer programs, depending, you can go as low as, we have 0% down programs, 100% financing.
100% financing. So that is the thing now.
That is a thing.
Is that through
It has
FHA or?
FHA has one, yes.
Did you do a first and a second, or is this one big loan?
You
like
can
a VA
do
loan?
first and second. You can do one loan, and the lender will give you the 3.5% down payment, which is my favorite program. Because when you get
that's cool.
when you get two loans, both rates are going to be higher because of the risk factor, and then you're going to be able to afford less. So we get a lender that gives you 3.5% down payment. The rate for the first 6 months is going to be higher because they're going to. How do they pay for your 3.5% down payment? They're going to give you a higher rate. Because whenever you go, like let's say the average rate is 7%, right? Mm-hmm. If you go to 7.75%, lenders at that point, there's a rebate attached to a rate or a discount. So they can take that rebate for a higher rate and apply it to use it for your down payment. So in essence, you take it 7.75%, let's say the market is 7, take it 7.75%, zero down payment. You still need closing costs. Right, you still need money for your earnest money deposit because you got to open that up. So I would say about $10,000 to $15,000 you still need, even if you're doing 100% financing program. Okay. Even those programs, if you do 100% financing, you can utilize seller credit to help pay for the closing costs too, if clients don't have enough money. Right. So it's about structuring that deal. But there's 100% financing, and then the great thing is with the FHA, it's the FHA program, one loan, you could refinance 6 months later, as long as there's a 0.5% improvement in the rates, then you could do what they call a streamlined FHA refinance. No appraisal needed, no income documentation needed again. They just want to make sure that there's benefit. It reduces your liability and allows you to be able to create equity faster and get out of the FHA program. Because FHA doesn't want them on your books for lifelong anyways. Right. It's a starter program. Okay, so you're going to be guaranteed to reduce your interest rate in 6 months. Because of the difference between rates where that program is and what the actual rates are. So,
is there any issue with adding buyer concessions for buyer's agents onto those?
You can do seller if the seller's doing basically a concession for buyer's agent compensation, right? That is separate. You can do that, and that's separate from the maximum that you could credit that you can get in a transaction. Right. So let's say, for example, depending on a down payment you put down, let's say the seller can give a maximum of 6% seller concession in order to help with closing costs and things like that. That's 6%. But let's say if you get 2.5%, you're giving seller's going to give a buyer's agent compensation. That's not included in the 6%, which is great. So that's one way where you're still allowed to get more credit and build that in. You can't per se build in the credit, right? The compensation. The seller provides a credit for the concession for the compensation.
So I'm buying $1 million home.
Yes.
I want to add a seller concession to that. Can I then go in and write the offer for $1,025,000?
Okay. Yes. There's another way of doing it is like basically increasing. If you're buying it for $1 million, you put 1.025, and then you ask for 2.5 back.
Yeah.
Yes. Here's a caveat: we want to make sure that it appraises for $1,025,000.
Right.
Right. If it doesn't, then obviously you'd have to renegotiate again. Right. But nevertheless, at that point, you already have the credit in the contract, right, for the seller's agent, buyer's agent commission. And hopefully they adjust their purchase price in order to still have that credit and based on the value of the property.
Did everybody catch that?
So in essence, you financing it. Okay.
Yes, but understand what he just said. It's enormously important. You negotiate it in. Once it's negotiated into the contract, whether or not the house appraises or not, the seller has agreed to pay that compensation.
Correct.
It is now part of the contract. Now we have to start working on pricing.
Correct.
All right. Now we can really get into getting back and forth. It's how you lock yourself in and ensure you're getting paid.
Exactly.
Okay, one last one.
Yes.
One last one. We only got a couple more minutes. Okay, let's say I have like no credit score and I want to buy a house. Is that possible?
Yes. We have an FHA program with no credit scores. You can have one credit score. You can have two credit scores. And we can go down.
So is it
credit
no score, or is it whatever? You have
No
negative.
score.
You have negative, and it's a zero. Like you have some
So
delinquencies.
some people, no, that's not how it works.
So
some
it has
people,
to be like you're a blank.
yeah, some people don't have credit lines.
Yeah.
Right?
So
Trade
let's say you
lines.
just got out of college, no credit lines.
Right. You know,
Stuff like
about
that.
Right.
But if you
All
got
the-
a 500, you're not getting a loan.
Well, yeah.
we have loans
You
up-
have a zero with a bunch of delinquencies.
Yeah, so you cannot have scores, right? In general, does your credit bureaus are not reporting anything because you don't have trade lines. You can still do FHA loan. We can do FHA loans and VA loans down to a score of 500. Okay?
Good Lord.
Here's a caveat though. FHA, you get a tradition put 3.5% down. If you're going to go a score below 580, so 500 to 580, you got to put 10% down.
Okay.
Risk factor, right? So they want more skin in the game if they're going to go that low.
Okay. Now, what about, okay, let's say I want to flip a property.
Ooh, love those. A lot of programs. Want to buy $1 million property, right? So I'm buying $1 million property. I'm going to put $100,000 down. I need $200,000 to rehab the property. As long as a property is worth 30% more after you fix it up, the lender will give you the full $200,000 for the rehab. So that's a fix and flip. They technically, you're putting 10% down of the purchase price. They'll give you the rehab money, and then as long as there's enough equity in afterwards, in order to be able to do the deal, but it's a simple deal.
So you got to come up with 10%.
10% of the purchase price.
Okay, one more.
It's a lot better than 20.
Yeah.
Let's say I don't even want to give you a social.
Well, people that don't have socials, a lot of them, right? They come
Yeah,
here.
let's say like I want money to buy a house and I don't have anything.
Well, you need something, right? If basically a lot of foreigners or came here, they're establishing themselves, waiting for citizenship. And they're working, they're paying taxes, right? As long as you have an individual tax identification number, you can get a loan. Okay, so you show your
What
tax.
about private money? Is it
Private money, there's going to be, their criteria can get very low as far as a minimum credit score. You got to have a
you
credit
have to
score.
have a credit score with private money?
Yeah, you got to have a
So
pulse
you
or
can't be
something.
like, hey, give me a bunch of money, put a lien on the property.
If you have, there's exceptions getting made. If you have you want to get $1 million out of a $10 million property, maybe they won't care about your credit score, right? Because you have so much equity in it, right? So, but credit score is important. Two things I want to say. One thing is credit score used to be very important, and for people that are putting down less than 10%, okay, before America used to incentivize having great credit, right? But now if you're putting down less than 10%, it may be more beneficial to do an FHA loan. And FHA loans, you can have low credit, right? So it kind of defeats the purpose of having really great credit if you're putting down less than 10%. You might have to do an FHA loan, which is FHA loans are meant for people, first-time starters, and they don't penalize you for having bad credit scores. So where do you see the benefit of having a great credit score? Is if you want to do non-conventional loans, which is alternative documentation and less documentation. And then having a great credit score, more than 10% down, that's where it's really, you're going to save a lot of money. For jumbo loans, for any other loans, that's when credit becomes important.
Got it.
So it could cost you, and people have to put down larger down payments nowadays because of affordability, right?
Got it.
So,
Well, that gives us a lot of good information on loans and stuff like that. I just want to touch on a few hot ones.
Yeah.
Because I know the agents and stuff, I work with people. The 100% financing is fabulous. I love that one. Looks like we run out of time right now, guys. But I want to thank you guys for watching and big thanks.
Thank you both for
shout out
having
to
me.
Omeed,
Thank you, Vance, for
VP of
hosting.
West
I
Shores
appreciate it.
Financial, for coming out here, taking time out of your day,
my
came away
pleasure.
from your team, and giving us all this good information. And we are really looking forward to seeing what happens in our market. with our new president, I think we're all hyped up for that. And
Absolutely.
hopefully our clients and sellers and everybody and buyers will have more confidence in the market. We can start making money again because it's been rough. But I want to thank you guys for tuning in. Again, Amir Al-Kayat signing off, episode 21. And we have
Vance Mizzi, as always, ladies and gentlemen, it's a pleasure to be with you today. Thank you for taking the time. And Omeed, thank you for sitting in the hot seat with us.
Thank
and,
you. It's been a pleasure. Looking forward to
we
doing this
pulled
again.
no punches, and I
Thank
appreciate
you.
it, brother.
Appreciate you. Thank you,
all
both.
right, everybody.